Let's talk to Gaurav Sharma. He's an oil markets analyst and Forbes columnist. Welcome to the show.
Good to be back.
Okay, you've got one slide.
Well, that's the direction. That's the first quarter panning out for you. If you look at if you have the slide up, and I think what we have here is the oil market is oscillating between $55 and $70, and that's the range that it has stuck in. The highest Brent has achieved is about slightly above $70, but you know we have the Bolton effect in full swing in the crude markets. There's an equities sell-off, and the oil prices, Brent is again within touching distance of 70, oscillating around about there. And that's because President Trump, overnight, while we were asleep, appointed one John Bolton and kicked out one H.R. McMaster. And this, our friend Mr. Bolton has been on record saying bombing Iran is not a bad idea, that we should strike North Korea first rather than wait for them. So you know that what his thinking process is, and the crude market thinks, well, you know what, this is chance for a bear run. So based on anecdotal evidence, a lot of these hedge funds are piling in saying, let's see if we can make this rally last. I don't think it's contrary to market fundamentals. There's still plenty of oil out there, but the Bolton effect is now in full swing. So we're sort of touching. That said, and the viewers of this broadcast will recognize, I'm still not deviating from my oscillation range of $55 to $70. I still think come the end of the year we'll be at 65, but there are lots of factors in play here. First of all, the conspiracy theorists thought the Saudi crown prince and Trump got together, so Iranian sanctions on the cards. Then the Bolton effect comes into play, and then all the bears saying, well, we've got some crumbs of comfort. Let's drive this up. It probably won't last because a $70 oil price is not just good, it's very, very good for US shale. So more US barrels on the market, that has a downside effect. But probably still, my thinking is unchanged, still $65 a barrel is about par.
Right, so in terms of the Bolton effect, you're saying that the hedge funds are piling in and you think we're at the top of the trading range. Okay, what's the best way to make any money out of this? Do you basically buy put options? Do you go shorts? What are you thinking?
Well, this is a week to go long. But again, I think people that are watching this broadcast think I'm a bit of a broken record. I'll say go long, trade on the news if your spread is out there, but still remain net short. That's how I'm looking at it. So if you look at if you could bring up the chart again, if you look at this quarter, it has been an exceptionally boring quarter. You've got all the three benchmarks. The highest Brent has achieved is 70. The highest the West Texas has achieved 66. And the OPEC benchmark is somewhere in the middle. So the market is behaving reasonably normally and it's reasonably boring. So don't expect that oil will overshoot to about 75 to 80 unless Mr. Bolton does something really dramatic. And on the downside, I would think people watching the broadcast is that don't think that 20 or 30 or 40 is on cards, because the market is somewhere in the region where OPEC cuts are holding firm. They've been quite good at it, and they've been quite good at publicizing that they've been good at it as well. So this is the boring range we're likely to stick in with the odd spike stuck in the middle.
Okay, so finally, I'm going to say that the notes I read recently, that they reckon there's a premium of about $10 in the price of oil for geopolitical type risk. With North Korea's situation calming down, okay, obviously we've got this guy who's unknown. He's made some, big headlines. But wouldn't you be a seller for choice?
Oh, that's a tough one.
Because the world is a better place, isn't it, in terms of geopolitical...
After all, Trump has said that he will talk to North Korea. So yes, well, that's a tough one to call. The only thing that weakens that hypothesis is that if you actually subscribe to a $10 risk premium theory at all, because a lot of analysts out there, and I happen to be one of them, seem to subscribe to the theory that the $10 premium that we had around about the time when we started slapping Iran with sanctions, that has kind of dissipated courtesy US shale. Americans are no longer interventionists. They're no longer, because they have, by the end of this year, they would have overtaken Saudi Arabia and could overtake Russia. So the geopolitical map has changed, the dynamic has changed, which is why I kind of don't subscribe to this $10 premium theory. Now, it'd be a good opportunity to sell. They probably wait another few sessions, see how it all pans out. But nonetheless, I think overall crude will come to settle around about 65.
Gaurav, on that note, thank you very much indeed.